to record this session, and we welcome you and hope that you get a lot of information that you will be able to utilize to go out and purchase your first home, or tell a relative about how they can purchase a home, or a friend. This is strictly educational. My name is Denise Mathis. I am the broker of record for DEM Financial Services and Real Estate. We are a boutique brokerage located here in the city of San Diego. With me today, I have a few of my team members, Angelica Wallace, who you will hear from. Also, Clinton James, our broker associate, you'll also hear from him. We'll also have joining us Shalimar Hill. She is our real estate coach. We'll have Megan Singh, who is our Riverside County specialist. So if you want to get outside of San Diego County, you will always be able to go up to Riverside County. And these programs, except a couple, work any place within the state. With that, I would like to start and tell you that our very first presenter is going to be Lionel Ponchard. He is the broker of FRMC, and he is going to be bringing us information regarding the original VA loan. And without further ado, Lionel Ponchard, would you please come on stage?
Happy Monday, everyone, and thanks for having me. I'm excited to be here and talk about the VA loan. I've been doing VA loans for about 35 plus years. I've probably closed 1,500 plus VA loans. I was doing VA loans when we used to have to hand carry requests for certificate of eligibility and appraisal requests to a Department of Veteran Affairs in Los Angeles. So I go way back. So I'd like to give you a little bit of history about the VA loan and how it came about. In 1944, President Franklin Delano Roosevelt signed into law probably the most significant piece of legislation in the history of this nation. It was called the Servicemen Readjustment Act. And what that act was it was a game changer. It was business loans, it was farm loans, it was college tuition, it was books, free education, and of course, the crown jewel of that act was the VA guaranteed home loan. The VA guaranteed, this act was designed to level the playing field of returning veterans who sacrificed their time in the military, and some, of course, gave the ultimate sacrifice, their lives, when they returned, trying to level the playing field by allowing them to purchase a home or get a free college education, okay, or purchasing a home with zero down payment. Okay, so what are some of the advantages of a VA loan? No down payment required. There's no mortgage insurance. You know, FHA and conventional loans, if you put down, well, all FHA loans require mortgage insurance. Conventional loans, if it exceeds 80% loan to value, requires PMI. On a VA loan, there's no mortgage insurance, period. There's no prepayment penalty. There's limitation on closing costs. The VA doesn't fund the loan. The VA guarantees the loan. Different, okay? So what are the types of property can these veterans buy? VA loan is intended for primary use, single family residence, condos, townhomes, up to 4 units, manufactured, even modular homes. Condos, of course, must have VA project approval. VA is really receptive to a project that has FHA approval. They'll pretty much rubber stamp that. And so if you've got a project that's received FHA approval, it's pretty easy to get VA approval. So what are the unique requirements of a VA loan in terms of property? It's called MPRs, minimum property requirements. They want the house to be safe, they want it to be structurally sound, and they want it to be sanitary. And I won't go into all the detail about what all that means. Other great advantages of the VA loan, they can be used over and over and over. As long as you pay off one, you can use the other. Sometimes you can use what they call partial eligibility. And there's a formula that we calculate, and we don't have enough time for me to go into all that while we're on the phone. One of the things that I like about the VA loan in terms of the appraisal process, a lot of agents think that, hey, VA appraisals are really, really tough. Well, there's a thing what they call Tidewater. And that's simply, it's called the Tidewater Initiative. It was initiated in 2017. When a VA appraiser goes to a property and he's struggling to come up with value, he can't just send in an appraisal and say, hey, this property is $5,000. I can't come in with this price. He won't tell an agent where he is in value. He'll just say, hey, I'm initiating the Tidewater Initiative. That basically says to an agent, they have basically 3 days to come up with comparable sales to maybe the VA appraiser does not have. How is that an advantage? FHA appraisers won't do that, nor will conventional appraisals do that. So that is kind of a cool little feature about the VA loan. It's called the Tidewater. There's approximately 22 million veterans in the United States, and probably less than 12% of the veterans actually use this great benefit. It's such a untapped market. If I normally do this presentation in about 3 hours, and we talk about some of the marketing aspects and how you can reach veterans and what lines of work they're in, and different ways of reaching out and connecting with this community of heroes. And maybe on a different time, a different day, we can go into that. So if you've got, if you like one of my PowerPoint presentations, just put something in the chat and I can send you a PowerPoint. I'm just basically ad-libbing today, and feel free to ask me any questions.
Okay, we are going to leave all our questions to the end of everyone's presentation. So I'm going to ask that any questions that you have of any of the presenters, that you place them in the chat or write them down if you don't have the ability to type in the chat. So Lionel, you still have a minute. So I'm going to ask you, 45 seconds, who is the VA loan for?
Oh, the VA loan is for veterans who've received an honorable discharge. It could be, they don't have to be first-time buyers, but they do have to have honorable discharge.
Or active duty.
Or
And active duty?
It could be active duty. It could be active duty. Yes, correct.
And reserves who have served enough time?
Correct.
Okay, so again, Lionel, I'm going to ask that you place your information in the chat, and I am going to let you guys know up front that all of our industry experts, just about all of them can do any of the loans that they're talking about. So he was selected to talk about veterans, but as we bring up each and every presenter, they all do these programs, or they'll tell you that they can't. So thank you very much, Lionel, for telling us about the eligibility and what is available for those who have served in honoring their service. So that particular loan had to do with serving in the military, 100% no money down. What if you haven't served in the military and you still want to try to get 100% down? Our next presenter we're going to bring up, he is going to talk about another 100% financing, and where you do not have to have military service. I would like to introduce Alex Zier of stronger lending.
All right, thank you for that. The tee up, I appreciate it. My name is AssistanceThe. I'm a mortgage broker. Strong Lending is a boutique team here in San Diego. Like she said, like Denise said that not only are we able to execute on the program that we're about to go over here shortly, the USDA home loan, but we are eligible to help folks use all the programs that are available in 49 out of 50 states. So to go specifically into the program, the USDA home loan is a program from the United States Department of Agriculture, just like it sounds. It is sometimes referred to as the USA Rural Guaranteed Housing Program. It's a mortgage that's offered to rural property owners in America. And, just being fully transparent, it's a program that a lot of, loan officers and real estate agents don't get a lot of at-bats at unless they're, very specifically in these neighborhoods. But I'm actually helping a client in Central California right now through this program. And so I've, had a little bit of experience with it recently. USDA home loans have a maximum household income limits. This one is kind of interesting compared to, the other government program, which is the FHA. Now, this varies by county. So, whichever county you're purchasing the home in, and the income limits can change annually. The maximum household income limits are based upon everyone in the home who makes money. So even if their income is not going to be used to qualify for that program specifically, this is also something that's a little bit different. So for instance, Social Security income from an elderly relative living in the house would actually be considered towards the maximum household income, even if that relative, for example, were not going to be on the loan. This is a very specific sort of difference or differentiation from a lot of other programs that I think people wouldn't think of. Let's go into the sexy part of the program, because that's what we're all here for. The most exciting part of the program, she already had mentioned, is that it's 100% financing. So that's fantastic. There is a funding fee, but you can roll that into the loan. So, 100% financing, can't beat it, right? There is a related mortgage insurance associated with this. But one thing that's a little bit different, I'm learning this because I'm helping a client with this right now, is that these programs have a pretty competitive rate compared to the market conventional loans. And so obviously, when you have a government guaranteed program, the government is essentially putting their thumb on the scale to make it happen. And that's why the rates tend to be a little bit better than conventional financing. The program is address specific. So that's how you find out if you qualify for it. But typically, these rural areas is where you're going to find homes that qualify for it. Another thing that's very interesting is there is actually no credit score minimum, as long as you can demonstrate your ability to make payments. And so they use kind of a different underwriting feature. You can only use it to buy single family homes, and it must be owner occupied. So, no multifamily. I know I've had people ask me about farms or like acreage properties. Most people typically make those kind of mistakes when they hear USDA, which kind of makes sense. But no, it's intended for a single family home. One unique function that I like to mention to folks about this program is that for people who actually already own a home in a rural area, there's a feature called a rural repair or rehabilitation loan. So the very low income housing repair program provides loans and grants to very low income homeowners to repair, improve, or modernize dwellings, particularly for health and safety reasons. So you have a client or you have a friend or family member who lives in a rural area that don't make too much money. Maybe they don't make any money enough to qualify for a loan. They can actually activate this feature of the USDA program to borrow some money, have a government guarantee, have a mortgage, so it's affordable for them, and to get their home to the standard necessary. So to summarize, I think there's four main things that you want to remember. There's no down payment required. You must meet the income restrictions per county. The property must be in a rural area as defined by the USDA, and it must be owner occupied. And those are the four most important parts. And that's
Thank you.
it for me.
Thank you so much. And again, I did see a question come up in the chat. We are acknowledging the question. However, we're going to wait till the end. And if our presenters will follow the chat, you can be prepared for the question. So we have covered 2 loan types, which is 100% financing, no questions asked. Next, we are going to talk about another loan type that does require down payment. And for that particular one, we are going to bring to the stage Laura Borja with Ocean Lending.
Hello, everybody. Did I unmute myself here? Let me see here. I think I'm unmuted. Can you guys hear me okay?
Yes.
Okay. All right. So I'm going to be covering FHA loans. An FHA loan, just the basic, is a loan that is insured by the Federal Housing Administration, which is part of the Department of Housing and Urban Development. So HUD, so when you hear FHA and HUD, that is what that is about. FHA, just like with VA, does not make loans directly. They will insure them, or in this case, insure them, or VA's case, guarantee them for the lender in the event that the borrower defaults on the loan. And you know, one of the primary focuses and the reason, the mission behind FHA is to try to increase the ability for more people to become homeowners, with a special focus on trying to increase homeownership among the minorities or underserved communities. Some of the basics for FHA eligibility is the borrower must have a valid Social Security number. You must, the borrower has to be in the States legally. You do not have to be a U.S. citizen or a permanent resident alien. They can be done for people who are here on a work visa, as long as there's sufficient time left on it. The assets have to be assets and income have to be fully documentable. So there's no stated income, stated assets kind of situation allowed for FHA. And the borrower must intend to occupy the property as their primary residence. When it comes to the property type, single family homes are obviously allowed, as well as condominiums. So condominiums do have to have an FHA approval. If the project as a whole has not already been approved or the approval has expired, it is possible to do a single unit approval. It adds a little bit of time and cost to the transaction, but if you find a condominium that you want and it all works out, it is possible to get that one unit approved. And also manufactured homes. Asset requirements, as Denise mentioned, this does require a down payment. Minimum is 3.5% down. And the money there is some flexibility as to where the money comes from. Obviously, it can be from your savings, from your retirement accounts, but it can also be from a gift or from a grant or from another down payment assistance program to help you either come up with a 3.5% or to provide a bigger down payment than the minimum 3.5%. Cash reserves, which is what some lenders look for after the closing, after you did your down payment, paid your closing costs. There are some programs that want to see that you have money left over after the end of the transaction. This program does not necessarily require it unless you are buying units. So if you're buying a 2 to 4 unit property, they are going to require that you have some cash reserves in order to be eligible for that kind of financing. Now, one of the what some people consider the cons of an FHA loan is that it doesn't matter how much of a down payment you give. All FHA loans are going to have mortgage insurance. There is both an upfront mortgage insurance premium that is paid, but you can roll that into your loans and finance it, as well as a monthly mortgage insurance premium that is paid. And we'll go over the amounts on the next page. So the mortgage insurance. There are limits. The amounts are based on the loan size as well as how much of a down payment you give. That also is going to dictate whether or not you are going to have that monthly mortgage insurance for the life of the loan or for a shorter term. So this is not a situation like conventional where you can remove or petition for the mortgage insurance to be removed once you have a certain amount of equity built into your situation. So as you can see from the chart, which I can send out to you if you are interested in looking at it longer, these new premiums that are being used to calculate your monthly mortgage insurance just came into effect this past month. So it is making FHA loans a little bit more affordable. The amount that you're paying on a monthly basis has come down. One of the advantages of FHA mortgage insurance for those that have the lower credit scores is that it's going to be much cheaper than conventional version of private mortgage insurance if you were comparing a 3% down conventional to an FHA. Someone with a lower credit score is going to have very expensive monthly mortgage insurance on a conventional loan, where FHA does not change that premium based on your credit score, simply the amount of down payment you give and the size of the loan that you are taking out. For qualifying, another advantage of an FHA loan is that they have much more flexible qualifying guidelines. When it comes to credit scores, there's technically not a credit score, minimum credit score requirement. And as a matter of fact, you can build alternative credit. So for those of you who maybe have no credit score, verifying your rent, verifying your insurance payments, your telephone payments, your cell phone payments can build what we call alternative credit, and they can make you eligible for an FHA loan. However, every single lender, every single investor will have their own overlays. So you do want to check with a specific lender that you're working with to see what their minimum credit scores are. And in many times, if you do have a very low credit score, they're going to require more down payment than just the basic 3.5% down. Another advantage is the debt to income ratios. So where some of the conventional programs will have a very strict and tight debt to income ratio requirement, FHA does allow you to push the envelope a little bit more, therefore maximizing your purchasing power. And so those are the basics for me for FHA loans. There are a lot of ins and outs that can be discussed, and there are a lot of different ways to try to tailor the right situation and maybe pair it up with a down payment assistance program if needed. But that at least gives you the very basics of the transaction.
Okay, thank you so much, Laura. And if you have questions, please put them in the chat. And we will go through all of the questions at the end of the program. Next, we're going to ask one of our team members to come up and talk about a very specific program that she has to help you get into homes. And that is Angelica Wallace, part of DEM Real Estate. Angelica.
Yes, hi, my name is Angelica, and I've partnered with a foundation called Home for Heroes, which allows me to say thank you to service members and community heroes and assisting them in saving money when they're buying or selling a home. As a mother, caregiver, and military spouse of 30+ years and a realtor for almost 20 years, I understand the sacrifices in life we all provide. Community service and giving back is a passion, and Home for Heroes have provided me the opportunity to give back to local heroes through their foundation. Not only can I give back to an individual buyer or seller, but I can also nominate a nonprofit organization to receive a $10,000 grant from Home for Heroes Foundation. As a realtor, being part of your home ownership team is a joy and a goal for me. The mission of Home for Heroes is to provide extraordinary savings to active, reserve, and veteran military firefighters, including EMS, all law enforcement agencies, medical professionals, and all educators who have provided extraordinary service to our community. It's just a way of saying thank you to our nation's heroes. Simply put, Heroes saves money when they use my expertise when buying or selling a home. Like again, the heroes are these people in front of you: the firefighters, the law enforcement, the military, the medical professionals, and educators. Basically, through the Home for Heroes Foundation, they have served over 56,000 heroes since 2009. They have given over $1.1 million in grants since 2010 and have closed more than $14 billion in real estate volumes. On an average, heroes can save about $3,500 when they buy or sell real estate using my services as a Home for Heroes specialist. And what that comes out to is basically about $700 per $100,000 of the sale price that you'll get back as a reward from me, personally from me. So if you purchase a home that's $600,000, you're basically going to get about $4,200 in rebate back from me as a thank you for doing business with me. Also, if on the Home for Heroes program, they do have mortgage lenders that work with this program, and they also give you a savings. A lot of them, they may provide you a waiver. They may pay for the appraisal fee. They may also not charge you loan origination fee. So depending on the lender, the mortgage lender, there are also additional savings that you can achieve by using a Home for Heroes lender. It's just 4 simple steps to do this. Just call or text me. My number is here. Work with me and my team to buy or sell a home, and you'll receive your hero program. There's no red tape, no hidden fees, no catch, and no maximum fees or purchase price or income that you'll have to meet those 4 simple steps. And this is my information. You can reach me. Telephone, calling me or texting me is best. My email address is here. I don't just sell homes, I change lives, and that's, my goal.
So thank you, Angelica. Again, we're going to wait to the end to do any questions. And what we just heard was, and you'll start to hear us talk about it, and that is income restrictions, property restrictions, etc. But Angelica is able to offer a program where there are no restrictions. So if you don't fall into the other categories, here's a way of you hooking up with Angelica to get down payment assistance that comes directly from her, and she can place you with one of her lenders who will be able to save you costs because they're also one. Thank you again, Angelica. So now we are going to go into cancel. Lender-specific programs. Okay, so I'm the one that's messing up. Let's do this. Okay, let's see if I can share my screen. Okay, so I am sharing my screen, I hope, maybe not. And I'm going to start right here. And we have many lenders. Can you see my screen?
We do not see your screen. No, we do not see your screen.
Okay, well, I may do it without the screen. Okay, so there are many of our lenders out there, such as Chase, US Bank, Citibank, etc., who have very specific down payment assistance and closing costs that they offer when they do your loan. So without further ado, we're going to have 2 of those lenders come on today to talk about their lender-specific programs. And the very first one is going to be William Bertice with New American Funding. William, would you come on stage?
I am on stage. Good well, it's not afternoon, it's evening. I'm William Bertice with New American Funding, and I want to thank Denise and DEM for inviting me here. with all these loan programs that you're hearing today, there's no reason why becoming a homeowner is not possible. There's something out there for you. And I'm glad to introduce one of our really cool programs called Pathways, because we want to help create a pathway to home ownership. And how this program works is you have to be considered a first-time home buyer. And let me clarify what first-time home buyer is. Let's say you owned a home, but someone that you're buying a house with has not owned a home. Then to do this program, that will consider you a first-time home buyer. So as long as one of you are considered a first-time home buyer and purchasing the house, then you qualify for this program. You'd have to buy at least one single-family residence. So that could be a single-family residence, a condo, or townhome. We can do up to 97% loan to value, which means that your minimum down payment required for this program is 3%. You have to do a 30-year fixed mortgage, and minimum FICO score is 620 required. And I didn't even mention this. The cool thing is we can help up to $6,000 with this program. That can cover either your closing costs or help with your down payment. Most of the clients that we use it towards your closing costs. That can help towards your closing costs. But whatever you need help with, $6,000 can go towards your closing costs or your down payment. To be eligible for this program, you have to meet one of three requirements. One is you have to purchase in the right census tract. So the program that you are buying, when you find the home that you want, we have to input that address to ensure that it meets the census tract to qualify. And then you also have to be at least 80% area medium income. Each city that you purchase in has a different area medium income. And for the city of San Diego, it's about $85,000. So if you make $85,000 or less, you qualify for this program where you can receive up to $6,000 in grant funds. If you make above 80% area median income, don't worry, you still can qualify for this program as well, where we can help up to $6,000 towards your closing costs, which will be considered lender credits instead of a grant. So the way you receive it is a little different than if you make less than 80% area median income, but nonetheless, you still can receive up to $6,000 in grant funds. And the other option that's available is an opportunity to receive up to $8,000 towards lender credits, or towards a grant funds that can help towards your closing costs or down payment. The only way to qualify for that, though, is you would have to be moving from a certain residence. And in this scenario, you have to either move from Atlanta, Baltimore, Detroit, Memphis, or Philadelphia. There's a lot more to go into this program, but I have a short period of time. So I just want to continue the show. But if you guys have any questions, feel free to reach out to me, 619-484-2843. Thank you.
Thank you so much. And we are going quickly, but our idea is to let you guys know what is out there, okay? $6,000, that's a lot of money, okay? Our next one is a little bit more money, and I would like to bring to the stage Bruno, and I mess up your last name all the time, so I'm gonna let you say it. He represents Bank of America, and he had some money for you, and you may have to go without what you sent me over.
That's perfectly fine, Denise. Thank you very much.
I'll give it a shot, but I can't guarantee it.
No problems at all. My name is Bruno Zaraga. I'm a community lending officer with Bank of America. I'm a seasoned professional. I've been in the mortgage business over 45 years, and my passion is working with entry-level buyers such as yourself. Bank of America has what's called our community homeownership commitment. What Bank of America has done is we have set aside $15 billion. I'm going to repeat that again, $15 billion with a B. And the purpose of those funds is to help entry-level buyers such as yourself purchase a property. Denise, if you could go to the next page, please. My NMLS number is 347608. What Bank of America is able to do with these funds is this. We're able to offer you a down payment of up to $10,000. And when I say a down payment, it's a down payment grant. It's either going to be 3% of the sales price or $10,000, whatever is the least of those two numbers. In addition to that, we also have what's called our closing cost grant. That closing cost grant is going to be up to $7,500, and that closing cost grant is to be applied towards non-recurring closing costs. And to give you a little bit of background as to what it would entail in order to go ahead and qualify for these programs, you do have to take a home buyer education class. It's a relatively simple class. It's an online class through Homeworks. In addition to that, the income limits, this program does have income limits in San Diego County. The maximum that you can earn in San Diego County in order to qualify for this particular program is $160,000, just to shade over that number. You do have to purchase in what's called a designated area. The designated area, simply stated, is a low or moderate census tract. And if you have any questions as to, what is a lower or a mod census tract, I'd be more than happy to go ahead and look that property address and tell you what properties do qualify. Now, we have helped over 31,000 families with this program. We got plenty of money still left in the program. I think out of that $15 billion original acquisition, we've still got roughly about $7 billion left in it. So we got plenty of money, and that program is a program which is good nationwide, but it's pretty much good in all of Southern California. So it's not limited to just San Diego County. Now, it's a 3% down payment program, and it's conventional financing. So you do have mortgage insurance, but the mortgage insurance that we do have is also a reduced premium on the mortgage insurance. In addition to the interest rate that is charged on this particular program is premium financing. So the interest rate is lower than what you would get on a regular conventional loan with 5% down. So we're doing everything possible to help that entry-level buyer get into that house. The limit in terms of the maximum sales price would be $726,200. We can go over that limit. We can go up to $1,089,000, but that would require a 5% down payment. So I will be here. If you have any questions whatsoever, please put them in the chat, and I'd love to address those questions after our presentations. Thank you very much, Denise.
Thank you, Bruno. Again, please place all of your questions in the chat. And it's a lot of things that we have here for you. So with it being so many different programs, I would like to talk about a tool that we have with the California Association of Realtors. I'm going to place in the chat a website that you can go into, and all you need to do is answer their questions. Are you a first-time home buyer? Have you ever been in the service? Are you in the military or a teacher? What is your basic income? Put that information in, and then you will be able to see all of the various different down payment assisted programs that are out there for you. So we heard about USDA. If you say that you're a veteran, it's going to pop up. If you say you want to buy in a rural area, it'll pop up. If you're a veteran, it'll pop up. So whatever it is that you are, if you answer their questions, then you will be able to see what's out there and rely on us, but you can do some research yourself. In addition to that, if you're working with a realtor who is a designation from the the National Association of Realtors, there's additional money that they would have for you also. So I just want to let you know, I'm going to put that in the chat. Don't think that you have to know everything that we know, but we want to give you the tools that are available out there to help you find out what is available. So with that, a lot of people on here want to know, okay, we're talking down payment assistance. That sounds great, but I want to buy some units. So guess what? You can do that too. So with that, I'm going to bring up Eric Frazier, who is very experienced. He is going to tell you how you can purchase a 2 to 4 units as a first-time home buyer using down payment assistance. And Eric, come on up and I'm gonna let you guys know, Eric has a couple of gigs. We're gonna talk about his lending background, but he's also a minister. I gave him 7 minutes and 59 seconds, and you know it's hard to control clergy. So Eric, if you'll come on stage now, and let's see what you got going on. Eric Frazier with Residential Bank Corp. I think you are on mute, Mr. Power is now. There we go.
Okay, all right. Thank you, Denise, for this opportunity. Again, my name is Eric Frazier, and I'm the Senior Vice President of National Sales at Residential Bank Corp. My license number is 461807. Residential Bank Corp is a national lender in 48 states. The only 2 states we don't lend in is Hawaii and Alaska. And we specialize in everything, truthfully, from down payment assistance to investing type programs, bank statement programs, you name it, we do it. The program that would help you acquire a 4-unit property with down payment assistance is unique, and that is coming from down payment assistance. There's only a few organizations, and reality is that there are state housing finance agencies and nonprofit organizations in every state providing down payment assistance. But many of them have restrictions on the number of units that they will allow you to receive down payment assistance. Here in California, the Golden State Finance Authority is one of those entities that will allow you to purchase a 4-unit property and provide you the funds for the down payment. And so this program is called the Golden State Finance Authority, and they've been around for 30 years, started in 1993 as a public entity and agency. And their goal or mission is to provide a source of financing for Californians. So far, over 84,590 families have acquired homes using this financing, and they have put close to $649 million in down payment assistance. I have worked with them exclusively for a number of years and have created several educational videos that you can find on the powerisnow.com. I want to encourage you to go to Power Is Now TV on your iPhone or Android phone, and you can find the Golden State Finance TV, which we produce and distribute. There you'll find the details of the programs they have to offer, and I think you'll be amazed. In regard to 4 units, and this does not just apply to 4 units, whether it's a 1-unit property or a 4-unit property, the Golden State Platinum program will allow up to 5.5% to be used for down payment and or closing costs. Unlike some programs that put limitations on how the money can be used, the only limitation is that it has to be used for down payment or closing costs. You're not limited to just the down payment or the closing costs. Another unique feature of the Golden State Platinum program, as well as all of their programs, by the way, they have another program that is temporarily on hold, so we won't even talk about it. The Platinum program will allow you to purchase a home even if you own an existing property. So if you own a home right now and you're looking to downsize, or you're looking to get more space, you do not have to meet the standard first-time home buyer requirement, which means that neither you or your spouse, if you're using the California Housing Finance Agency, but with most programs, neither you or your spouse can own a home in the last 3 years. They also have flexible income requirements. Now, for the conventional product, you'd be surprised how high the income limits are. But the conventional product would not work. The only product that will work with the down payment assistance is the government programs, FHA and VA. VA requires no money down, and so now you're working with an additional 5 to 5.5%. FHA requires 3.5% down, and so now you have money on the table still to apply to a down payment or closing costs. In addition to that, this program works with USDA and conventional financing, but when we get into USDA and conventional financing, you're looking at single family properties. The down payment is a loan. It used to be a loan that didn't require payments. You just had to pay it off when you sold the property or you paid off the first mortgage. Now it is a loan. So the standard program, up to 5% of the first mortgage amount, it is a second mortgage, and the interest rate on that mortgage is equal to the first mortgage. It's a 15-year fully amortized loan, and it's still a great deal because it gives you the money to get in. Now, if you are a first responder, there's a program called Platinum Select, and I'll let you know who are the first responders that qualify. On the Platinum Select, they will allow a 3.5% down payment assistance, which would be a loan fully amortized for 15 years, interest rate equal to the first mortgage, but 1.5% will be a gift, and it's an absolute gift or grant. There's no repayment of the funds whatsoever. So again, the first part of it, 3.5, is a loan amortized for 15 years. The second part of it, 1.5, is a gift. Now, a first responder would be someone who is working in law enforcement, border patrol agents, correctional officers, anyone in a law enforcement capacity, firefighters, CAL FIRE, paramedics, emergency medical technicians, people working in education, current members of the California Teachers Retirement System, University of California Retirement Plan, employees of a California accredited private or charter or public school. And so it's pretty amazing the help that they make available to teachers. Now, there's also a program for county employees, and there are a number of counties that qualify, and you'll find the best opportunities to buy 4-unit properties in rural areas. The down payment assistance in this particular case, if you are purchasing in a qualified county, is deferred. The second mortgage is 3.5%, but there's no payment and it's 0 interest. And then the remaining 2%, so now you're up to 5.5, that is an absolute gift. And again, it's a game changer because the second mortgage on the 3.5 is at 0 interest, no payments associated with it, and it's due when the home is sold or when you refinance or sell the property, either case. Now, the counties that are eligible for 0 interest deferred payments are Alpine County, Amador, Butte, Calaveras, Colusa, Del Norte, a lot of the counties, rural counties in Northern California. And then there are some rural counties out here in Southern California that are eligible as well. Reach out to me. I'll be more than happy to get into the long list of counties. So just to reiterate, the down payment is eligible. The down payment assistance is eligible for 4-unit property. This is one of few programs that I'm aware of. It does exist in other states, and we do recommend it, that you take advantage of it. I recommend that any first-time home buyer seek to acquire a 4-unit property before looking at a single-family home. Real quickly, here are the underwriting requirements. You must occupy the property as your primary residence. You can, though, use a non-occupant co-borrower to qualify. So that's another great benefit, which is not available on many down payment assistance programs. The minimum FICO score is 640, and that is with a minimum or maximum debt ratio of 45. But if your FICO score is 680, then you can have a debt ratio of 50. The eligible properties are, again, 1 to 4 units, But if you're looking at a manufactured home, which is a great deal, then the minimum FICO score goes up to 680, and the maximum debt ratio is 45. There is no manual underwriting on these programs. Condominiums and townhouses are also eligible, but they have to be FHA approved, and the loan limits are going to be based on the FHA county loan limits, depending on where the property is located. So I would highly recommend you reach out to me if you're interested in purchasing a 4-unit property, particularly in a rural area. The best values are there, but there's some, anywhere downtown in California, but they're very expensive. Now, if you're not needing the down payment assistance, then you can go above the conforming limit, which is the maximum loan. They will not do the 4-unit limit on an FHA loan, which is close to 1.3 million. They will only go to 726, I believe, 250, the maximum loan, regardless of the number of units that you're going to acquire. So that's my presentation, Denise, on the 4-unit property. It's a game changer. Everyone should look into it. You can reach me directly at 714-475-8629, or go to applytobuynow.com, applytobuynow.com, and there you can find additional information, my contact information, and can start the process online.
Wow, that was a lot. Okay, so all you have to know is, do I want to buy 2 to 4 units? And if you do, there is a way. We do all the work. I'm a real estate professional. I was listening to him and it's like, wow, wow, wow. Oh, that's that. But that's what they specialize in. These are industry experts. So if you have the desire, you give us a call. And one of the things that I missed in the front at the beginning is that what came first, the chicken or the egg? And many people ask, what comes first? Do I call the lender or do I call the real estate professional? I am a real estate professional. I've done the lending, but I'm going to tell you, come to us first. We know our partners. We know what they can do. We don't know everything that they know, but we know how to put you in touch with the correct partner that's going to get you the keys to the home that you desire. So thank you, Eric. And I believe that you went ahead and did the Golden State Finance. I let you go over your 7 minutes and 59 seconds. If you have anything else for Golden State Finance, let me know. And next, we're going to bring up Clinton James, who has a very unique program that he's going to speak of. And Clinton is with DEM Real Estate. He is the man that makes things happen.
Yes, thank you, Denise. As she said, I'm the man that makes things happen. So we're going to make it happen in 3 minutes. So yes, so I'll try to be very short and sweet. My name is Clinton James. I am the broker associate with DEM Real Estate, and my task today is to talk about the San Diego Black Home Buyer Program. This is a very progressive program here and a very specific program, demographic specific and area specific program here in San Diego that was administered by the Local Initiative Support Corporation, which we call LISC. So I think, yes, so here we go. That's the slide. So, so with this program here, there's no repayment requirement. It's actually, it's free money. So everybody loves free money, but at the same time too, it's a grant. The grant is not taxable for federal income tax purposes. So that's even more amazing. The grant is up to $40,000. So those are the 3 key points for this program here. It's actually facilitated by the housing counseling, through housing counseling provided by the Urban Leagues of San Diego. And then we have a lending partner, US Bank, formerly known as Union Bank. They give additional funds to this, which is up to $9,000. So it's specific to San Diego. It's specific to a demographic. It's going to be all inclusive on the next round. So this was a program that was created to help with the low percentage rate for Black homeowners last year. Now, the eligibility requirements Number one, you have to be a minority, Black or African American, current resident of San Diego County. You have to be a first-time home buyer, and the area marginal income should be 120% or less. Now, just to let you all know about this program really quickly is that it did run out of money like most grants, but it ends in April 2023, which is this year. But the second round of funding is coming up pretty soon. So please let us know. We'll let you know, reach out to me anytime or reach out to anybody on the team and we'll let you know when it's there. But there's so many other programs out there we can point you in the right direction to. I always say if you have a desire to buy a home, we can get you there into the home. It doesn't have to be into one of these programs, but there's so many of them we can go over. The anticipated program to be is inclusive. As I said, it's anticipated to be inclusive coming in the next round. So yes, contact us anytime. My number is 619-384-9269. As we always say, we have a slogan here. We say we don't we sell homes, we change lives. Thank you. See, I had my timer on. 3 minutes.
Hey, you're the man. You are the man. You know how to do it just right. Thank you, Clinton. You know, I'm sorry, he's with DEM Real Estate and he is all that in a bag of chips plus some other things. So if you're looking to buy or sell real estate, remember, we don't just sell, we change lives, and that's what we're all about. He was actually before his 3 minutes. So now we would like to get into some other down payment assistance programs and that are done in the county and the city of San Diego. And for that, I am going to ask Alicia Suras with Gill Mortgage to come to the stage. Thank you.
Am I on the stage?
Uh-oh. I think I put someone else on the stage. Let me go back to Alicia.
That's okay.
There you go.
Well, Denise, thank you so much for having me here tonight. I work for Guild Mortgage. I've worked for Guild Mortgage for 22 years. I just had my 22-year anniversary here at Guild. And my specialty has been, like my niche product through the entire time has been helping first-time home buyers. And it's just amazing, this knowledge wealth that you've gathered here, because I learned some things tonight. So I appreciate everybody giving their information because it's been very beneficial to me as well. Basically, the down payment assistance programs, when I work with a first-time home buyer looking at down payment assistance programs, there, you know, like you said, Denise, there's so many available. Like there is so much information on this call that if I were a first-time home buyer, my mind would be spinning right now, not knowing which direction to go. So, you know, that's what I try to do with my first-time home buyers is break it down with all of these different programs and see, you know, what fits, because you know, it's the customer who has to fit, it's the property that has to fit, it's the area that has to fit, it's the income and credit scores that has to fit. There's so many things that have to fit that it can become confusing and challenging to figure out what to try for. So I'm just going to start by giving an idea. Can everybody see my screen, the San Diego Housing Commission screen? Okay, perfect. So San Diego Housing Commission, SDHC.org, they manage first-time homebuyer programs that go along with traditional types of financing. So if I were doing a first-time homebuyer program in conjunction with the San Diego Housing Commission, Guild Mortgage would fund a traditional first-time mortgage. And then here on the link, there's a link for first-time homebuyers. And on the first-time homebuyer link, you can see the different options available. So within the San Diego Housing Commission, there's different options available based upon what you're trying to accomplish, based upon what your income is, based upon what your household size is, based upon what area of town you're looking to buy in. And the San Diego Housing Commission funds within the city of San Diego, which is zip codes that begin with 921, and within the county of San Diego, which are basically zip codes that begin with 920. And then there's some municipalities that have their own zip code. I mean, their own specific program. So again, it just really depends on what you want to buy and how you want to do it. Some of the downsides of working with the Housing Commission is they really are probably one of the most complicated programs to work with. They require any adult household member who's going to be moving into the new home to complete qualifications and meet the guidelines of their program. So where some of the programs that they just want to talk to the initial buyers, the San Diego Housing Commission requires every occupant of the home to meet the guidelines. So every occupant of the home that's over 18 years old needs to complete the application, needs to provide their income documentation, needs to meet the credit score requirement, and then everything is added together to meet the debt to income ratios. So it's a little more, it takes a little bit longer to find out what someone qualifies for because there's more information to pull together on those. And then also the municipality programs generally require their own inspectors to look at the properties. So while in a traditional transaction, there's a home inspector that the realtor recommends, the city of San Diego and the county of San Diego programs, they have their own inspectors that go into the home and call out any required repairs. So that can be challenging also. And because when the city calls out a repair, it has to be fixed during the course of the transaction to qualify for the funding. So there's absolutely programs available. If someone wants to see what they qualify for, generally borrowers with the lower income qualify for more programs than moderate or higher income properties. Another opportunity that the San Diego Housing Commission offers is affordable for sale housing. With the affordable for sale housing, it's kind of a new thing, and it's also with new construction right now, where in a community they will determine houses that have to be sold to low income buyers, meeting their guidelines, and the San Diego Housing Commission actually controls who's able to buy these homes. And when they go for sale, the San Diego Housing Commission will set the price of what that home is going to sell for. And it's a below market price than what it would, or what the market price is. So that's something that the San Diego Housing Commission offers as well. They're not always available, but when they are, it's an amazing opportunity to be able to live somewhere where you wouldn't ordinarily have the opportunity to live at, because the market values are so much higher than the restricted price that the San Diego Housing Commission sets. The negative of purchasing in these communities is when you go to resell the home, the San Diego sets the sales price. So you wouldn't be able to profit from the sale of these homes as you would from the sale of a traditional home, because you got to get in at a below market price, but you also have to sell at a below market price. So you don't, it's not like owning typical real estate because your payment is much lower. So those are just some of the programs that the San Diego Housing Commission offers. And other municipalities have programs too, like the County of Riverside has first-time homebuyer programs. The City of Riverside has first-time homebuyer programs. The City of Oceanside is working on an affordable housing project right now with KB Homes. So there's lots of different projects that the municipalities are working on. So once you know where, once you've identified where you want to live, then you can see what programs can work in conjunction with the financing that you're applying for to help you maybe get a little bit of a different opportunity. I think that's it. I don't know how I did on time.
Thank you so much. You did very well. That gives us the opportunity to have more questions and answers. Again, we don't expect you to take it all in. All we want to let you know is that there's a program out there for everyone, and go to the industry expert so they can say, this program for you or this program's for you, okay? So Now we are going to go into one of the programs that everybody's talking about. It's the best thing out there since running water. And that is this new 20% down payment. And we have none other than Mr. Dion Westbrook from New American Funding to come before us to give us some particulars about this 20% down payment that everybody is talking about. Dion, you're on stage. Take it away.
All right. Hey, how's it going, everybody? I just want to say thank you for sure for giving me the opportunity to come here this evening and talk about this special program, and they say it's a dream for all. And I definitely do believe that, because once you understand how the program works, it really can get you into a home for pretty much for free, out of pocket. Yes, you still have to make payments, but if you understand how this program works, it will absolutely get you into a home with no money out of pocket. What I want to do is kind of briefly just run through it. Some of the stuff has been said because some of these guidelines run hand in hand with most programs. So I'll just kind of run through some of the stuff that's pretty similar since we're kind of short on time. So just real briefly, just talking about how it works. First off, let's talk about what some of the minimum requirements are. So you have to be a first-time home buyer. What that means for a lot of people, sometimes I hear people say it the wrong way. First-time home buyer means you are someone who has not owned a home as your primary residence in the last 3 years. So you can actually own a home, you just can't have lived in that property for the last 3 years as your primary residence. So that's a big difference of what someone who doesn't own a home versus someone who does. So please make sure you guys understand that. You must live in it as your primary residence. You got to move in within the first 60 days once you purchase the home. You can't have any what we call non-occupying co-borrower. So what that means is you can't have someone that's going to co-sign with you that's not going to live in the property. Only people that are going to live in the home can be on the actual loan. Okay. Another good thing about that too is when we're talking about as far as people that's going to be alone. So some other down payment assistance programs out there, they actually qualify you off household income, where this particular program will only qualify you for whoever is on the actual loan. So the great thing about that is, let's say if you have a married couple and both of them make $200,000 a piece for a total of $400,000, if you're somewhere where your income limits would only allow you to go up to $200,000 or $300,000, what we would do is possibly take one of the spouses off the loan and then qualify you off that one person. If they can qualify for you to buy the home that you want, then that's how we can get creative and get you into a house without having to worry about getting hit for household income. So that's a nice special feature about this program that I really like about it. The next thing that I want to talk about is the program is called Dream for All Shared Appreciation. So what does that mean? Some people like to say shared equity. They both mean the same thing, basically. So what happens is when you buy a home, the amount of funds that you use, which with this program, you can get up to 20% that can cover down payment and closing costs. Now, what happens is out of that 20% that you get, you can use it separately, or you can use it in multiple ways. You can use it to where it can cover all 20% of your down payment. That would put you in a situation where you don't have to have mortgage insurance or anything like that. Or what I'm going to possibly be teaching people, more than likely teaching people in most situations, is to not use the full 20% towards down payment and actually break some of that up and actually go towards closing costs. Because if you do that, that's how you're going to be able to set yourself up to be able to buy a home potentially for free. So for example, let's say if you want to put 16% towards your down payment and only 4% towards closing costs, more than likely that's going to be almost enough to almost cover everything, if not cover everything, depending on your purchase price and things along those lines. So once you understand how it works, you can definitely set yourself up. So that's why you want to have an experienced loan officer that can teach you how to properly set yourself up for success and getting creative with this financing. Another good thing about the 20% is you can use some of it towards down payment, some of it towards closing costs, but you can always use some of it to pay mortgage insurance off too. So someone wants to find out how that works, how you can get creative and help gain more purchase power by doing things like that with some of these funds, I'll teach you that. Well, we just don't have enough time for me to get into it now. But now let me get back to explaining how the shared appreciation works. So with this program, if you were to use the full 20%, when you get to the point where you're going to do something that's called a trigger event. So that means maybe you sell your property or you try to refinance where you want to take cash out, or either maybe go 30 years and without purchasing, or without selling your home or refinancing cash out, then you have this loan will become due. Now, what happens is you're going to have to pay back the full amount that you used. So if you use 20%, you absolutely going to have to pay at the bare minimum 20%. But where the shared appreciation comes in is any appreciation or equity that you gain above the original purchase price, they're going to ask you to pay back up to 20% of that appreciation, with a maximum of no more than 250,000. So you would have to gain a substantial amount of equity, before you did something triggering to where they can take up to 250,000 of your funds. Now, what happens is if your income is under 80% AMI, which that stands for area median income, and the way we can figure that out, just so to kind of explain, I heard people say it a lot, but I want to explain to you guys how you can figure out how to find out what area median income is. So what happens is there's a website called Home Ready Loan Lookup Tool that you can click on, and you can put your address of a home you're looking at, and it'll tell you where 80% level is. And if your income that you make is under that, then they only take back 15% of your equity once you do a triggered event, whether which if you sell the home, refinance, take cash out, anything like that, they'll only ask for 50%. So us as a loan officer will tell you when you hit those marks. Now, as far as loan to value, you can go up to 105%. A lot of people ask me, can this program be layered? So I want to show you this because it can. The only thing is you have to have a grant program or something like that that meets Fannie Mae's guidelines. And on top of that, the Dream for All second lien has to go in second lien position. So any kind of grants that you get that may meet Fannie Mae's guidelines, you can go above that, but you can't first mortgage, the Dream for All, and any other grants you try to layer that meet the qualifications can take you above 105% loan to value. So you need to understand that's how it works. I just want to show you guys a quick screenshot of some of the income limits by county. As you can see, it gets up there. You can definitely get all the way up to $300,000 if you look at San Francisco County. So I highlighted some of the more normal counties that I see people doing loans in, where you got Los Angeles up to 180. Here, San Diego can make up to 211,000. San Francisco, 300,000. Alameda, 282. So those are some of the, the more normal counties that I see people doing loans in that I work with, I should say. So when you see these income limits, that's when I brought up the situation earlier, where if you had a husband and spouse that combined made over any of these numbers that are highlighted, you can take one of them off and see if you can still qualify to buy the type of home that you want. And they will not ask you what the other person's loan income is. That's not going to be on the loan. So that's how we get creative. You do have to do home buyer education with this class. So I see a lot of people saying you do have to do one class, but with this particular program, if you're going to do the Dream for All part of CalHFA's program, you have to do two classes. So you have to do the one regular home counseling class, and you also have to do a CalHFA home buyer education that's specifically for the share appreciation program. Now, some of the property requirements, I hear a lot of people saying you can only do like a single family home with this program, but you can actually purchase a single family home with a ADU residence on it. So we would have to make sure that the home is qualified as or classified as a single family home with only one maximum ADU on it. It can't be a 2-unit or a duplex. It has to be a single family with ADU. You can also buy condos and manufactured homes as well. So as we're looking at the properties, myself and the real estate agents, we'll make sure we understand, if you're looking at property, we'll make sure it fits it within the guidelines. Some of the real quick debt to income ratios that you have to work with, or that we have to work with. If you're someone where your credit score is over 700, you can get up to 50% debt to income ratio. If you're someone whose credit score is under, we can go to 45% max, and that's your front end and back end debt to income ratios. And if somebody wants me to explain that, you can reach out to me and I'll go into detail. Credit score requirements. If you're someone who, this is a conventional only loan, so basically where we need to be at is a 680. If you're someone whose income is over that 80% AMI level that we talked about before, if you're under that 80%, you can actually go down to 660. So I hear a lot of people saying 680 is the minimum. It really is actually 660 if you understand how this works. All right, so here's just some key factors to remember about this program. Again, the funds can be used to cover full down payment and closing costs. I'll work with you to get creative so you can understand which mix works the best for you to maximize your purchasing power. I hear some people saying you have to put funds in your own pocket. You don't have to put 1% or anything like that. You use all the funds that can come directly from the 20%. These funds might run out quickly. Most people, they were only allowed it 300 million. So trust me, if you're looking to buy, you need to move quickly. It's not for some, that's probably people that may want to look at doing new builds that might be built in 3, 4, 5 months down the line. That's not going to work for you. You can't lock your reservation prior to open escrow. I already have several people asking me, hey, can you lock my reservation in or lock some funds? No, we can't do it. You got to get into escrow before you even have a shot. And then there's some guidelines that might kick in before that. Again, our admission, you got to take 2 classes. Oh, here's one thing I actually taught CalHFA today. If you do the e-home counseling class, that's the one where you have to you can do a virtual class, and then afterwards you have to get a 30-minute follow-up call. Right now they're backed up to June. So you definitely want to look into possibly doing the Neighborhood Works or a HUD-approved counselor class, an in-person 8-hour class to where you don't have to wait for that 30-minute follow-up call. That's going to be the way to go. If you do the 30-minute one or you do the e-home one, and you have to wait, that could delay your escrows and may put you in a situation where you might fall out of escrow, someone might lose some money. We already mentioned you can get a single family home with this. And again, I want to say you got to work with an experienced loan officer. You know, don't try to work with someone who's never done these programs, because if they don't understand how it works, you can actually get tripped up and end up losing your escrow, losing your earnest money deposit, and being in a situation where it can cost you a lot of money. So I just want to, you know, briefly throw some of the main factors about this program out there so you can understand it. It really is a great program. You really can buy a house with little to nothing out of pocket, if not anything out of pocket at all. Besides maybe putting your earnest money deposit, you could potentially get that all back if you work with someone that can structure this loan properly for you and teach you how to become a homeowner. So I didn't really have too much time more than that, but if anybody has any additional questions, definitely feel free to reach out and hit me up. Sorry to have much more time, but we definitely go deeper with this program for sure. It's a lot to it, but I love it. I learned it. I know how to do it. Hit me up if you guys have any questions.
Thank you, Dion. Again, lots of information, a very good program, lots of bells, whistles, and nuances. What we're asking you to do is contact the lender, okay? Contact the real estate agent to get specific. One of the things that I want to do is, we're talking about no money down, okay? But we need to let you know there are some upfront fees and things that you have to pay, but it can all come back in the end. And some of those things are, you are going to have to make an earnest money deposit, and your earnest money deposit is normally wired to escrow within 3 days of an accepted offer. It can be anywhere from $2,500 to $5,000, up to 3% of the purchase price. In a competitive market, the more money that you have, get your offer accepted, okay? But that's money that you will have to have liquid in your bank account. You are going to have to be able to pay for your appraisal. That's something that you're going to give to the lender, okay, which can be $450 to $1,000. Again, most lenders will ask for a credit card. They charge your card if you back out of it. If you don't, it's all rolled into your closing costs. Physical inspections. All of these home buyer programs are going to require that you have an inspection. The inspection is $450 up to $800. It's based on the age of the home and the size. That's going to be payable to the inspector at the time of inspection. Note, if you're a firefighter or a military person, usually they have discounts. You might want a termite inspection. That's about $100, and it's typical payable at the time of the inspection or receipt of the report. With me, I have an agreement with my inspector that he waits to get it from escrow. If it's an older home, you may want to get a sewer inspection. This is just so you know everything about the house. So basically, though, that is money that you do have to have upfront, able to send out, but you can get it back in the end at the close of escrow. So we are now going to ask for questions and answers. We have one more presentation that if you do want to find out about how to purchase a 4-unit, 10 good reasons, then that's what we're going to ask you to do. So right now I am going to bring everybody back on stage. That was a presenter. And let's see if someone else can help me. Let's do this.
Actually, can I add one more thing real quickly, Denise?
Yes, you can.
I just want to say one more great thing about the Dream for All program is it does allow you to do high balance financing. So this is where you can go up to high balance purchase prices up to whatever the county limit is, to the maximum high balance county limit. So that's another thing that I want to throw in there as a key factor for this program. So for those people that's trying to get up in there in those high balance, those $800, $900, $1 million price range, you can utilize this program too. There's an extra cost to do it, but that can be taken out of the 20% too. So again, no one's working with someone that can structure the loan properly for you and get you to where you need to be and get you to a home and get you to build generational wealth. So I was going to throw that in there too. Sorry.
Okay, so as we go to the chat box, can someone tell me what the very first question was? And if you have a question that's not in the chat box, please write it down. So the first thing I see is, hello, are family members able to use the VA loan? Lionel, do you want to answer that?
It's for the veteran and his spouse, not for the family members. Now, there is some VA loans, some companies that will allow a non-veteran to be a co-borrower. But in the 37 years that I've been doing VA loans, I've yet to close a loan where a non-veteran, a non-spouse was a co-borrower, because they have to come in with a substantial amount of down payment. So
Okay.
it's usually a mood issue. Like I said, of the 1,500 plus VA loans that I've closed in my career, I've yet to see a non-spouse co-borrow on a VA loan.
Okay. The next one is for, I guess we're going to address it to Alex or anyone. What is considered rural?
I could answer that if he's not here.
Okay.
Yeah.
Alicia?
Well, my office is in Julian, so we're definitely rural out here. So rural is defined by the census and the population. So generally in San Diego County, Ramona's rural, Alpine's rural, Fallbrook has some areas that are rural. It's generally the more East County areas that have a lesser percentage of population versus the land. USDA has a website, and I can put it in the chat what the website is. And you can literally look it up by property address to see if that property is considered rural or not. You sometimes have to be careful because it might be, the designation might be one side of the street is considered rural and the other side of the street is not. So just because you look it up and this zip code is in a rural area doesn't mean it qualifies. You have to look up every single address. But when you get to the map, you can actually zoom in on it and see a boundary to get an idea of where you'd want to be looking for. So like Lakeside isn't considered rural, but Ramona is for the most part. Those kinds of things.
I put the link to where you can type in the address in the chat box. So if anybody wants to follow that, you go in there and type in the address and it'll pull it up.
Okay. And I just want to tell you, Alex, the only way that you're going to be spotlighted is if you come on camera. We have a question. What is the income maximum? Each program is different. And if the person asking that question wants to send me a text or an email and which program you're talking about, I will get you that answer and put you with that particular person, not knowing which program that you're talking of. Let's see. Are you only able to, ooh, here's a good one. Are you only able to participate in one program?
In theory, no.
Can you guys layer?
Yeah. Well, in theory, you can layer them, but you have to look at, especially when you're pairing them up with down payment assistance, you have to see what layering is allowed. I mean, you can pair up an FHA loan with some of the down payment assistance, but in this case, for example, you could not pair it up with the Dream for All that Dion spoke about, because that is strictly something that goes with a conventional loan. So I think that somebody else had mentioned the key is to speaking to somebody that knows these programs and knows how to properly structure them and combine them or not combine them to make sure that you have the biggest benefit of everything that is available to your specific situation.
Okay, I believe this one is for Eric. What is the name of the program for multifamily financing?
The Golden State Finance Authority Platinum Program. And by the way, there are no income limits for the Golden State Platinum Program, FHA or VA program. The income limits only apply to conventional financing.
Okay, let's sort this.
Also,
Okay, we'll go back
add,
to that. Look at this one, USD property. Are there any other questions? I don't see that there are any. Wait, here's one. Here's one. Is there, let's see. For any lenders, as a first-time home buyer, active duty, what loan do you all recommend? And what are any programs that work together with VA that will create my purchase price that probably is increased? Also, is there a way that you can transfer a VA loan with the interest rates as well?
You can.
Oh, go ahead. Or Jose?
Yeah, you can assume a loan. The hard part is if you're trying to maximize all the benefits of the VA, then you're gonna have to probably bring money to the table. So that's gonna be the harder part there. As far as maximizing some of the other down payment assistance programs, you almost wonder if it's even necessary. So it's such a specific question. It would probably take looking into your scenario, where you're looking to buy, what benefits make the most sense. That's probably what I would think. But the assumable part will be probably pretty difficult.
Yeah, just
I can jump in on that
question. As his response, yes, you can assume a VA loan. It has to be VA to VA or active duty to active duty. It has to be a veteran or an active duty member. You do have to also be very careful because it can put your eligibility in jeopardy. But so you have to make sure that you have to talk with a lender who actually specializes in doing the VA assumptions.
Hey, let me jump in real quick.
Don't want to give up their VA, eligibility.
Yeah, I'll explain to you for the assumption. So actually with the assumption, it doesn't necessarily have to be a veteran, but you would want it to be. If you try to use a civilian that assumes your loan, what happens is your eligibility would now be at risk. They would take over your eligibility. So you can do it with someone who's not a veteran, but I would never ever suggest it. I wouldn't do it if I was a veteran. If you're doing it with another veteran, you need to make sure that they have enough eligibility to take over the transaction, because you can potentially let them have your eligibility as well, just like a civilian, but you don't want to do that either. So the goal will be to make sure that do it with another veteran that has enough eligibility to take over your loan. And you could only do it with that person's lender. So you wouldn't talk to anybody else. You would be talking to that person's lender who their loan's currently with. Now for the young lady, Ms. Tim May, your CalHFA, the regular CalHFA loan has a VA option where you can actually get up to 2% towards closing costs. So if you're someone that needs assistance, that's a great opportunity for you that I can definitely help you out with, or anyone on here that does CalHFA can help you out with as well. But I would also say, don't be afraid of using the Dream for All. Even though you're a veteran, this is a conventional only option because you can get up to 20% down. Your monthly payments will probably be much lower than if you did 100% finance for VA. But then guess what? As soon as you get to the point where you can refinance and pay back at bare minimum the amount that you use, the 20%, then you go and do 100% financing on a VA loan. Then that's how you end up with the VA loan on your property, if that's something that you want to do. So
wow.
Exactly. So use a Dream for All, get into a loan with 20% down, or whatever scenario or combination we want to put with you covering closing costs as well, and then refinance when the time is right onto the VA loan. And your payments will be less upfront too if you did it that way. So I'm out here trying to teach people how to do it. Let's go.
Okay. That was worth everything for those veterans out there. So I don't see any other questions. Are there any raised hands? If
Can I
not,
ask a question of Eric? I came up with a question today on GSFA.
okay, go ahead.
Do you do construction to perm loans, Eric, through GSFA?
No, we do not.
Okay, all right, thanks.
Okay.
Denise,
Yes.
there was a question. It says, I currently live in an apartment in Oceanside with my 2 brothers.
Yeah, I saw that. That I'm going to handle personally.
Okay.
Okay.
There's also another question from
Okay.
Nisha. Are MIPs the same as PMIs?
No. No. MIP is financed on top of the loan and you pay a monthly premium. PMI is just a flat monthly premium. And once the loan to value drops to 75%, it automatically is removed from your loan.
Not necessarily.
Mortgage insurance premium and private mortgage insurance?
The mortgage insurance premium is what's charged on an FHA loan.
Correct.
FHA loan charges an upfront and a monthly, and the mortgage insurance stays on the loan for the entire life of the loan and it never goes away. Conventional mortgage insurance premium is typically called PMI, which is private mortgage insurance. So it's not government mortgage insurance, it's private mortgage insurance. And you can do it different ways. You could pay a lump sum up front. You could do a split premium where you pay some up front and pay some monthly, and you can do it where you just pay it monthly. And if you pay it monthly, once you've reached a certain equity position and you've paid your mortgage payment for longer than 2 years, you can ask the lender to cancel it by having a current appraisal ordered on your property.
And I would say, I actually want to add to that with FHA, if you put 10% down or more, your mortgage insurance can come off after 11 years. So I'm going to make sure you threw that in there. The one thing I want to kind of bring up real quick with that VA, the person asked a question about the VA loan with someone that's not your spouse. So I actually did just do a transaction where you had a veteran and his parents that bought a house together up to 1.2 million. And just to kind of tell you how that works, yes, you will have to put money down. So there's a formula that kicks in based on the situation. But what happens is you would have to split. So whatever the mortgage payment is, they'll split it in half based on the people that's trying to purchase. So if you have a veteran and his wife, they're treated as one. If you have a dad and a mom, then you would have to split the payment in half and they both have to qualify for their half separately. So it can be done. I just did it. So, and the benefits of that, even though you have to put money down, is if you're someone that has 20% down or something like that, you still get a home with way less than, because I think they only put like 12% or something like that based on their formula. But they didn't have mortgage insurance. They got better interest rates. So it is definitely something that's still out there. And plus you don't have any income limits with VA. So that's how they was able to buy up to 1.2 using the VA loan versus FHA, where you might have max county limit or conventional that will limit how much you can buy. So it's definitely doable. If you're interested, I could definitely teach somebody how to do it if anybody has some questions. I just did one recently.
Yeah, and I just want to add to another way that you can actually take on the mortgage insurance is through recasting or loan re-amortization. So that's something that a lot of people don't use a lot, but if you within a certain time period after the loan closes, within maybe 60 to 90 days, you can call a lender if you have a huge down payment or you win the lottery or something, and they put another huge make a payment, you can ask the lender to actually recast your loan to take out the mortgage insurance.
Thank you. Are there any more questions out there? Okay, so now I have a couple of questions and I want to thank everyone again for staying. And it's time for our audience to participate. What we have for you is a $25 gift card. If you put in the chat box, let's go to number 1 first. Okay, first question is, which program can be used for teachers and medical professionals? The first person to enter that into the chat box gets a $25 gift card. Team DEM is not able to participate. Does anyone know which one of those programs can be used for teachers and medical professionals? Oh, there we go. I couldn't see it. USDA, Heroes. USDA, can it be, is there specific for teachers and medical incentives?
No.
No, but technically it can be used for teachers and medical professionals.
Okay.
So
Well,
the technicality.
it's not eligible. You're not eligible by profession. So it's
Okay.
it's a property eligibility with an income restriction.
And Heroes? Is that program can be used for teachers and medical professionals?
Yes, it can.
Okay, looks like the first person is Mr. Jess Dancy Weathers. If you would please email me your contact information, we will send you a $25 Amazon gift card. I am putting in my email address right now. Let's go to question number 2. Which program can you use that only takes in consideration the person on the loan, not the entire household? Uh-oh, that's no fair. Okay, is it the DREAM program? We're getting the 2 thumbs up. Adam, if you will take and send me your contact information, we'll get that information out there. Question number 3. Which program can you use if you've had home ownership within the past 3 years? My lenders, have you seen a correct answer? I have California Dream and down payment with a question mark. Eric, which one of your programs can be used?
I'm sorry, the question is,
Which
what is it?
program can you use if you've had home ownership within the past 3 years?
The Golden State Finance Authority does not require you to be a first-time home buyer. You can retain your existing home as long as you occupy the property you're buying. Now, there are some additional rules in regard to retaining. If you have an FHA loan, if you're using an FHA loan, then other additional rules will require in terms of the distance of that property from the property you have.
Okay, so if you know someone that's already a homeowner and they want to buy another home, there is down payment assistance available for them. That is what the
That's right.
question's all about. Golden
That's
State
right.
Finance and all of the lenders basically do that. So we didn't have that one. Let's go to number 4.
Denise, one of the person put FHA, wasn't that also the right answer?
No,
No.
we were looking for a Golden State Financing. Which program can you use that does not, if you don't meet income restriction with the smallest down payment? No income restriction and a little down payment. Tim May, FHA. Please send me your contact information and we will get you your Amazon gift card. My email address, of course, is in the chat. I'm going to put it again. And we want to thank you. We said we are 15 minutes over. Remember, we are here to direct you to all of the tools that you need in order to become homeowners. We can put you with any of these partners. And we thank you. This will be recorded. We will send everything out to you. And you can get off now, but if you want the bonus on 10 reasons to buy a multifamily property using down payment assistance, please stay on. Otherwise, I thank you. If you have any questions, my name is Denise Mathis. I am a broker, and I do believe in truly brokering, putting people together to do whatever it is that they wish to accomplish. Thank you so much. And I'm here to assist everyone because I don't just sell homes, I change lives. Let's give all of our presenters a call, a clap. Thank you guys all for everything that you've done. And Mr. Frazier, do you need to share your screen? You
No,
don't.
I do not.
Okay, so now you guys are going to get the bonus from Mr. Frazier.
Thank you, Denise. One of the things that I absolutely love is educating first-time home buyers who are in the, I would say, the 80 to 100,000 range, are couples that are, whose incomes, combined incomes, between 80 to $80,000 or more. And the reason why is because they are in a unique position as first-time home buyers to be able to purchase an income property. And believe it or not, it is easier to qualify to purchase a 4, 3, or 2-unit property when the income is there than it is to buy a single-family home, especially in high-cost areas. And so what I want to lay out here are 10 reasons to purchase a 4-unit property. And in talking about those reasons, I'm going to get into the guidelines and the requirements. And so the first reason to consider as a first-time home buyer and buying a 4-unit property is that it is in fact easier to qualify. 4 units, 3 units, 2 units, you have to occupy one of the units. And because you're occupying one of the units, then we can use the other 3 units or 2 units, if that's the case, to add to your income. We're going to add that to your income. It is not going to be a dollar for dollar add. We're going to take 75% of the rents of those other 3 units, and that is going to be added to your income. The difference between 100% and 75% is called the vacancy factor. So the underwriter is going to assume that the property will be vacant at least 25% of the year. And so that's what they'll do. They'll give you 75% of the income added to your income. So that takes a person, if the average property is getting $2,000 per unit, 3 units at $6,000, 75%, that's $4,500, already added to incomes that are in the $7,000 or $8,000 or $9,000, whether it be combined or individual. It's a game changer. Number 2, as a first-time home buyer, you can buy a 4-unit property using FHA with only 3.5% down. I'm a homeowner. If I were to acquire, and I own 4-unit properties, a 4-unit property, I would have to put 25% down, 25% down. And there's no way the underwriter is going to believe that I'm going to leave my big fancy house to live in a 2 or 3 bedroom unit in a 4-unit apartment. And so the optimal time to pursue this strategy is when you're buying your first home. 3.5% down, FHA. If you're a veteran, there is no money down, 0 down. And if you're using the Golden State Finance Authority, which will allow you to buy a 4-unit property up to $726,000, then you've got their money. And so now you're looking at no money down, and you don't even have to be a veteran, no money down, just the down payment because there's closing costs. And the same thing with VA. VA means no money down, but there's still closing costs to take in consideration. That closing cost can be financed, it can be paid in the loan, it can be paid by the seller. If you're using the conventional product, it's 25% down. And so typically investors are using conventional products when it comes to buying 4-unit properties, but first-time homebuyers can use FHA or VA. Number 3, you are building for the present and the future. The reason we want to purchase a home is to provide stability for our family. So that addresses the present, stability. You get yourself out of chasing for lower rents, you stabilize your family. In addition to that, it also provides for the future. A 4-unit property sets you up for retirement income. Imagine buying a 4-unit properties in your late 20s or early 30s. By the time you turn 65, this property will be free and clear. And imagine what the rents are going to be 30 years from now. I have clients who are already experiencing this. In the chat room, I put some links of interviews that I've done with clients that I've helped. Single African-American woman, single African-American man. And today, not even 3-4 years later, they are in a position to acquire if they wanted to. The income on their rent, the cash flow on their rent is almost equal to the income they make on their jobs. So it is a game changer, and it can happen very quickly in this high rent environment that we live in here in California. Number 4, the income property appreciates at a much faster rate than residential income properties. Income properties in most states, particularly here in California, the appreciation will run between 7 to 10%. And for a residential property, single family home, it'll average between 5 to 7%. Now, I know over the last 10 years, we've seen double-digit appreciation, but it's been abnormal because of abnormally low interest rates. We're now in a normal market, believe it or not, at 6 and 7% interest, and we'll see homes appreciate back at a lower rate. But by buying a 4-unit property, you have the ability to control the value of your property. Unlike a single family home that will not be worth any more than other homes just like it in its neighborhood, and you could potentially, in trying to improve it, overbuild it for the neighborhood, you will increase the value of your 4-unit property each year you raise rent, because the value of that property is equal to the rent or the income that property can provide. Number 5, your rental income on the other 3 units will increase every year. And this is the next best thing of getting a raise on the job. If you've been listening to the news lately, we know that incomes have been stagnant over the last 10 years. And so even in some areas where there is very serious rent control, even with rent control, you're looking at the ability to increase your rent between 3 to 5% per year. Number 6, you have 3 units providing the income which is sufficient to pay your mortgage. Imagine you have eliminated your most serious expense. Most Americans, their largest asset is their home, their largest expense is their mortgage. Imagine being able to eliminate your mortgage payment completely and think about the money that you can save. Being able to save money over the same amount of money you were paying in rent, now you're putting in the bank. One of my past clients, Ina Ferdinand, just because she hasn't been able to make a mortgage payment, she's been able to save somewhere between $40,000 to $50,000 a year. And that's just in the not having to pay the mortgage. That does not include the additional cash flow that she's benefiting from the annual increases. Number 7, the unit you occupy will one day become a rental income also to pay the mortgage on your next purchase. You may, after 5, 7, 10 years, get tired of living in a unit, in an income property. You got married, you have children, you need more space, and so you don't want to tough it out anymore. But I can tell you, all of my clients are pre-approved and are looking now for their second 4-unit property, and they will be able to do that. Their goal is to have 20 doors before they retire to become completely financially independent. But if that's not your game plan, then you can buy a single family home. When you move out of that property, the income on that unit you're leaving will be somewhere between $2,000 to $3,000 a month, depending on where you're at. And that is additional income added, which in many cases will be able to pay a significant portion of the rent. The unit you occupy represents a future windfall in income when you move. Number 8, you'll be able to leave an inheritance for your family. And this is something that, particularly in the African-American community, we are not doing and have not been able to do, largely due to all the discrimination that took place from 1934 to about 1968. Billions of government loans were made to particularly white families, and less than 2% of those loans were issued to African-Americans. The ability now to purchase a home like this, pay it off, you now can set up a trust and leave income, passive trust fund babies you can actually create from the income from a 4-unit property, and that property will continue to generate income and assets for generations upon generations. Number 9, the tax write-off and owning a 4-unit property is significantly more than purchasing a single family home. You can have much more benefits. For example, on all mortgages, you can write off the mortgage interest, you can write off the property taxes, and you can write off and talk to your accountant about writing off mortgage insurance. But you can write off for sure mortgage interest and property taxes on all real estate. But when you have an income property, you can now write off the maintenance. Any maintenance you do in your property, you can write off. Any insurance expense from the fire insurance, you can write off. The property management that you will hire to collect the rents from the other units. Any repairs you make on the property, 100% of that is written off. Now you live in 1 unit, so you won't be able to write off 100% of it. You'll be able to write off 75% of that because 75% of the property is rented. So you get far more tax benefits in owning a 4-unit property than you ever could with a single family home. With an income property also, you can depreciate the entire value of the property and prorate the value of the property based on the fact you're living in one of the units. So for example, if a property is worth $800,000, the land value is $300,000, so you have $500,000 depreciating asset. Now, you'll be able to write off 75% of that, say $350,000, and that will be divided over 27.5 years. That amount of depreciation, which could run to be about $18,000 a year, is an additional credit to the income, to the rents on that property. So in your Schedule E, you have your gross rents. You'll be able to add your property taxes, your insurance, your maintenance, and depreciation, further bringing down the income on that property to practically nothing. It is a tremendous tax savings. Finally, number 10, you are creating a business. Believe it or not, you may not think you're in business, but if you own an income property, you are in business. So form a business. I do not recommend forming an LLC or a C corporation. Just form a sole proprietorship. That's all you need to do. If you form an LLC or an LLC or a C corporation, and you transfer that property into that entity, you will alienate the title on your property. You will trigger a due on sales clause, both in the note and in the CC&Rs of the deed of trust. So you don't want to do that. If you're worried about liability, get an umbrella policy. They're very inexpensive. You're forming an entity so that you now can write off all your expenses associated with that property, not only the direct expenses, but your travel to look at other properties, your vacations to Hawaii to look at properties there, your expenses in managing a property. You need a new computer, you need books, you need to take a course. You may want to get your real estate license. All of that becomes a tax deductible expense. And so those are the 10 reasons why to purchase a 4-unit property. I highly recommend it to every single client that I've been working with. For 41 years, I've been assisting people into achieving and building wealth in real estate and acquiring income properties. Please check out the interviews with the individuals I put in the chat room. I think you'll be inspired to do the same. And I wish that all mortgage professionals would talk to their clients about this. I wish someone had spoke to me about it when I bought my first home. Thank you.
Thank you, Eric. So we do need to build wealth, and that is an excellent way of building wealth. I do want to thank each and every one of you guys that did stay. And also, again, thank you to our presenters. Reach out to us if you have any questions. We will be doing follow-up because you took the time to come, so therefore you must have an interest. Thank you, and that ends it for now. Good night.
Thank you, Denise. Good night.